Hindustan Unilever among the top Nifty losers slips 6% after the company is posted a soft second quarter results. Volume growth was below street expectations on account of weak macroeconomic factors.
Navin Fluorine rises close to 4% on the back of a good quarter. The revenue climbs 10% on a year-on-year basis. The management sees strong order visibility for the coming quarters as well.
Shares of Escorts slip over 5% as it sells its rail business to Sona BLW for about 1,600 crore rupees. On the other side, shares of Sona BLW surged 10%.
In other earnings, Aster DM rallies more than 10% after reporting numbers that beat estimates. On the other hand, VIP Industries dips more than 4% after reporting a very weak set of numbers in the second quarter.
AU Small Finance Bank climbs more than 2% after delivering an operationally strong quarter, reflecting an improvement in net interest margin, although slippages have risen. In fact, stay tuned with us because MD and CEO Sanjay Agarwal will be joining us shortly to discuss the numbers in detail.
Hello and welcome to Chartbusters. I'm Nigel, with me is Mangalam, and as you can see, the Nifty is more or less flattish. The good news today is that the mid-cap index is still trading in the green, and the Nifty Bank, that's the one that the bulls have turned to, and they're calling them to play a good innings. And as of now, at least, the Nifty Bank is doing quite well. I think if you just pull up a chart, if you can pull up the Nifty Bank with the 100 DMA, you'll see that now it's just moved over the 100 DMA, and now in its striking distance, that's the 50 as well as the 20 DMA. Even in yesterday's trading session, the Nifty Bank managed to cross the 100 DMA on an intraday basis. But from the top, it did slip, and that was the cause of worry. Just take a look at that. You have the 100 DMA there. It's mildly above it, and it's heading towards 20 DMA. The bulls will like to see that take place. Mangalam.
Well, whether that happens or not is one thing we'll watch out for, Nigel. But, over the last 3 or 4 trading sessions, there's been so much volatility that commentary has been changing by the hour itself. So we'll just keep an eye out on how things pan out. But the two good parts about today's trade, apart from the Nifty Bank doing well, is the mid-cap index also has been doing well, outperforming the frontline indices. Yesterday, the mid-cap index at one point was up by almost 700 points. Did see a correction down to, just about 300 points itself. So this up move that has come by on the mid-cap index, do we see that, correct, or do we see that hold on is something that we'll watch out for?
Just one point, I want to pull up the intraday chart of Hindalco. And earlier today we had explained this, that normally the read-through from Constellium doesn't normally play through for Hindalco. We're just trying to point out that actually the correlation hasn't been there in the past as well. Hindalco was down more than 6%. Now it's recovered, it's down close to 4%. I think at the lows of the day, it was down close to 7%. The low of the day is 665 rupees. To alert our viewers, the mix of both these two companies are very, very different. Hindalco gets 60% of its total volumes, that is for the Novelis business from packaging, and actually Constellium sounded positive out there. So that could explain one of the factors that the stock has recovered from the lows of the day. 7% down, I think, is an overreaction. It's still down close to 3.5%.
All right, Nigel. So that's about Hindalco. We'll keep an eye out on that. No such, luck for Hindustan Unilever, which is currently at the low point of trade, sitting with a cut of almost 6% itself. But let's talk about another set of numbers that came by yesterday. It was MAS Financial Services. Reported a good set of second quarter numbers. Growth in assets under management being upwards of 20%. Dispersals as well, though there was some deterioration in asset quality. Kamlesh Gandhi, who's the chairman and managing director of the company, joins in now. Thanks a lot, Mr. Gandhi, for joining in. I remember, the last time you joined us, you did say that in the MFI portfolio, there may be some sort of stress as far as the asset quality is concerned, though you were very perturbed about that. On asset quality as well as the AUM growth itself, I'd like your comments because you've always been targeting between 20 to 25% AUM growth annually. This quarter, you've done around 21.8%. Do you stick to that AUM growth guidance and any commentary on asset quality?
So good morning. So as you rightly remarked that we always give a guidance anywhere between a range bound guidance between 20 to 25%. So on a consolidated basis, we grew at 22.7%. And going forward over a medium to long term, we maintain our guidance between 20 to 25%. But having said that, we don't mind a few percentage lower growth in favor of a better quality and a consistent profitability.
Hi, Mr. Gandhi. Good morning and good to see you. I wanted to ask you about your mix itself because the growth was led by the CV and the SME portfolio. And most on the street are sounding a little bit cautious on that front. But you're growing that segment. You're not worried about asset quality? Do you think that's okay?
See, as far as SME is concerned, we are one of the oldest financiers to this segment. We have the niche expertise. And if you see, we have been growing at a very stable pace of anywhere around 20-22%. And we are prioritizing credit quality over growth there also. And fortunately, we could maintain good quality there. On CV, the growth is on a very low scale. So if you see CV book it was hardly 800 crores last year, and this year it's around 900 crores. So the growth coming in CV is on a low base.
Right. You earlier pointed out that you don't mind, giving up some of your AUM growth for better asset quality. If you could, quantify that, because your growth is a wide range that you've given, 20 to 25%. Will you be in this range itself, or are we looking at late teens for the betterment of asset quality? And on asset quality itself, if you could give us a guidance.
So our top priority will be to maintain asset quality. And after that, whatever best we can do in terms of attaining anywhere between 20 to 25% will be done. Difficult to assign any number as of now. Our endeavor will be to be anywhere between 20 to 25%. But what I was sharing was that given the current situation, which is quite challenging at the market present, especially in terms of credit quality, if we find during the quarter that it is prudent to lower our growth by a percentage or two, we don't mind in favor of a better quality and profitability.
And what is the asset quality that you are looking at? Because we did see GNPAs actually, worsen to about 2.36 and net NPA as well move towards 1.57.
See, we have always maintained that we would be anywhere in a range of 2.25 to 2.5%. Given the segment in which we are working, there will be a range bound GNPS between 2.25 to 2.5%. So I'd like to maintain that guidance, that it will be anywhere between 2.25 to 2.5%.
Got it. What about your NIMs? It was a pleasant surprise. It's moved up a little bit. I was reading the RBI minutes, and maybe that rate cut may be postponed by a couple of months. So we'll see how that goes. But do you think the cost of funds has peaked out? And in turn, what would be your guidance on your NIMs?
See, as far as NIMs are concerned, this quarter we got the advantage of having raised 500 crores of QIP last June, in the last quarter, that is in the end of June. So that helped us to improve our NIM marginally. And going forward, we see that we'll be in a position to maintain our NIM anywhere around 7%.
Around 7%. The last calculated number we have is around 6.17%. According to your calculations, what was it in the past quarter?
It was around same. It was 6.85 to 6.9.
Okay,
Right.
so you expected it to maintain at the levels that we saw in the past quarter. Is that correct?
Yeah.
All right. What about return ratio, sir? What could you guide the street? Your ROAs?
See, ROAs will be anywhere between the range bound between 2.85 to 3%. And
Right.
that will be resulting into an ROAs of anywhere between 15 to 16%.
All right, ROEs of 15 to 16% with 2.85 to 3% return on assets. Quickly, if you could give us, two numbers. One is you were looking at reducing your share of NBFCs coming down from 34% to closer to 20-25%. Where does that number stand at? And secondly, direct distribution. That too was looking to, you were looking to increase that. Where does that number stand at?
So currently we are at around 67-33 in favor of our direct distribution. And going forward over a period of next 3 to 4 years, we'll see that our direct distribution will increase to anywhere between 70 to 72%. And the rest will be through our distribution through NBFCs.
So how does that change things for you? Because, on direct distribution, you will have to actually incur more costs as well, for which you will get a higher yield. Whereas for NBFCs, you get, you have to give them margins. So your yields reduce, but at the same time, your costs reduce as well. So what is the offsetting overall impact of this?
So right from the distribution through NBFC is close to a 15 years old module for us now. And right from the inception, we have tried to maintain equal NIMs, whether it is an equal ROS, whether it is distribution through NBFCs or whether it is distribution through our direct channels. So there won't be much difference whenever there is a shift in distribution to our direct channel from NBFC channel.
So then why go the direct way?
See, relatively both the books will increase, but you will agree that our direct distribution will grow at a faster pace as compared to our indirect distribution through NBFCs. Say, for example, we are at around 200 branches. We'll be close to 200 within the next 3 years. We'll be doubling our branches. But at the same time, we don't see doubling our relationships with NBFCs at the same. So there will be a shift in distribution configuration towards our direct distribution as compared to our indirect distribution.
All right. Thanks a lot, Mr. Gandhi. Always a pleasure speaking with you. 20 to 25% AUM growth guidance with asset quality being maintained between 2.25 to 2.5 for the GNPA. Looking at return on assets between 2.85 to 3.3% as well. We'll slip into a short break on that note. But before we do that, is a quick programming note, and it doesn't get bigger than this. Coming up on CNBC-TV18 today, a fireside chat between Jensen Huang of NVIDIA and Mukesh Ambani of Reliance Industries, talking at the NVIDIA AI Summit 2024. These two gentlemen will speak about AI's pivotal role in shaping industries and India as emerging global AI leader.
Welcome back. Markets as flat as can be as we speak. The Nifty bank is roaring away, though. That's moved to around 51,700. I'll tell you what, with all the pessimism that you're hearing, if the Nifty bank can move to 50,000 odd mark, you're talking about the largest constitute on the Nifty that will perform. And that will be great news for the Nifty bulls, because that's what could lead us a little bit higher from here on. We know the FI is a net short, not that aggressively so, but you require someone to put their hand up and get counted. And for the time being, it's the Nifty bank. Well, let's move on then. AU Small Finance Bank, where it delivered a strong operational set of numbers reflecting an improvement in the net interest margins. Those slippages did see a bit of a bounce up. We have Mr. Sanjay Agarwal, who's the MD and CEO of AU Small Finance, who joins us on the show. Hi, Mr. Agarwal. Good morning, and thanks a lot for speaking to us here on CNBC TV18. Well, the street likes what you have delivered in terms of a set of numbers. Give us some guidance going ahead as well. Your CDR ratio, well, that came down to, I think, 85% odd in the past quarter. So where do you see this number stabilizing at? And also on the cost of funds, I think you are guiding that it will fall by 10-15 basis points in the coming quarter. So do you believe your margins can hold at around 6% since you have just upsized your earlier guidance?
Yeah. Thank you so much for hosting me here. So I think this quarter, to be honest, is one of the quarter for us, and I'm telling you why the reasons. Like one, we crossed 1 lakh crore deposit base in this quarter itself. We crossed 1 lakh crore asset base in this quarter, and then also we applied for the universal license, right? So this quarter actually signifies one of the most important quarter in the journey of bank. And this quarter also, not only there was a growth of 12-13% in deposit, also we were able to manage our cost. Last quarter the cost was around 7.03. And we were not able to, we didn't do any kind of deposit growth in quarter one. And it was a very deliberate attempt, but quarter two, we need the money, and we grew in around 12,000 crores at a marginal cost, incremental cost of just 0.1 pips, right? So I think that helps us to really guide to the market that initially we were thinking to have a cost of around 7.2, 7.25
right
on a yearly basis, right? But now this has helped us to really guide us, even in the range of now 7.10, 7.12 on a yearly.
Right.
So that is really has given us hope that our NIM can be protected, and that is why we are guiding that our NIM can be around 6%. And again, our asset also has grown by 9% in first half, which is close to 40% of overall guidance, and that. If you take out microfinance portfolio, then our yield on other asset also has gone up. So the both put together, I strongly believe that our NIMs can be protected.
Right. Mr. Agarwal, you want to give us the CDR ratio that you're looking at?
Of course, we are around 86%. But to be very honest, if you take refinance asset out of the calculation, because the money which we get from NABARD, SIDBI, the assets we build through that money, we can take out from the from our asset base, then the RCD ratio is below 80%, right? So I'm quite confident that, the way we are building our deposit franchise, we can protect our CD ratio in the range of 80-85%.
Right. What you're saying, Mr. Agarwal, is diametrically opposite to what we heard from another NBFC management just moments ago. You are willing to let go of some bit of credit cost in pursuit of growth, whereas the earlier management said that they will not pursue growth at the cost of credit cost as well, because you increase your credit.
Where I'm saying this, that
No, because you
policy,
said that your credit cost has increased from 1.1% to 1.3%, and you are looking at higher NIM as well. It will be led by higher unsecured loans. So I just wanted to understand how much is unsecured as a part of your portfolio. Go ahead, sir.
No. So let me clarify there that
Yes.
our 90% book is secured.
Okay.
And that's our main franchise, which we have built over 28 years. Our wheel book is around close to 30%, which is growing in the range of 20-22%. And we want to build more wheel business because it's our bread and butter we have done over the years. The first half slippages are seasonal. You will always see like this over the years. The second half would be much better than the first half for the wheel business, MBL, SBL, affordable housing, and the gold loans. So we are not worried at all about that segment. Commercial banking has been perfectly fine in terms of growth and asset quality both. So we want to grow that business. So that constitutes of 90% of our business, right? The unsecured piece is only 10%. In that, 7.5% is microfinance. We are not growing that business at all because there are some challenges. We want to correct that course and then want to do that. And our unsecured credit card is just 3%, which is also, we have clearly said that we want to go back and learn the curve and then come back, right? And the unsecured piece is only 1%, right? And there the ROA is 3%. So I don't think that AU historically also has gone for more growth and has compromised their asset quality. That won't be case any time. We have to grow reasonably, sustainably, and the way the right business are being built, that's the key for us, in times to come also. Yeah.
All right. Very quickly, sir, the ROA guidance for this year, you'll do around 1.6%, and the next year you'll do 1.8%?
No. So this year, the way we are managing our NIM, and I strongly believe that we have done very well job around the other income, and of course we have saved a lot of money around OPEX. So there is some sharpness in our overall operating model for this year. So we should protect our 1.6 ROE this year. Our guidance for next year is 1.7. So it's a long way to go, but we will comment when the time will be there.
All right, take that point, Mr. Agarwal. Would have loved to have a longer conversation with you about your business, but take your promise to join us somewhere in the middle of the quarter, post-festive season. Give us a sense of how things are panning out as well. More importantly, on the demand front and also the lender, credit quality front in the MFI space too. Thank you so much for joining in. With that, we tell you another important programming note as we slip into a short break. And this is about the festive season. As we prepare to bring in the festivities this Diwali, tune into CNBC-TV18's Market Movers Forum. Today, 3 p.m. onwards on our channel itself, you have guests like Ramdev Agarwal, S. Naren, Nilesh Shah, and others to help you make your portfolio prosper this Diwali. Welcome back. The Nifty Bank continues to do well, up around 450 points, though can't say the same for a couple of these consumer-facing names. We've been talking about how HUL is lower, but just keep an eye out on Bajaj Auto. That stock too has moved to the low point of trade. We're seeing some weakness in names like Tata Consumer as well as Nestle as well. Nestle has moved to the low point of trade as well. We got that comment coming in from Suresh Narayanan yesterday that, the middle class is shrinking, and as a result of which there has been some impact on the FMCG consumption itself. Meanwhile, from the broader markets, though, some traction seen in a couple of these PSU banks. So pull up PNB. PNB is moved higher. Alongside that, we have Bank of Baroda moving higher as well. But mind you, these stocks have seen a big correction from the top itself. So maybe some bit of bounce back after a big fall. With that, we'll take a short break, come back on the other side. We'll have the team of Trading Hour take the market action forward. Thank you for watching.